Okay. Hi, everybody. Thank you for coming down and spending your. Is it Thursday? Thursday? Yeah, Thursday. Your Thursday evening with us. My name is Nathaniel, and this started off very casually, to be honest. So, Siwei, one of my friends came and said, "Hey, why don't we do something about ESOP?" And I've had many friends and founders talk to me about ESOP. I'll give an introduction to my background later on during the panel, but so I posted something very casually on LinkedIn to say, "Hey, few of my friends and I want to grab a beer and go to a pub and talk about ESOP." And here we are. It's not a bar. There's beer, there's wine, but it's not a bar. But it's quite funny how things go. So thank you for coming down. There are founders here, there are service providers, there are lawyers, there are bankers, there are people you like and people you don't like, whichever part of career you are in. And we are very happy to have you here. We've got MSW Ventures, Saison Capital, Palo, and obviously Mishcon de Reya with us to share their expertise. And I hope that this evening will be a great evening for everyone. Feel free to mingle. There are some drinks and food provided later on, and we are very happy to have you here. To kick off the event, I just want to invite Jeffrey Xia, who is the GP of MSW Ventures. I've known Jeff for a long time. He's done so many things. We'll leave the introductions for the panel later, but if not, can I please ask you to put your hands together to welcome Jeffrey to kick off the event for us? Thank you.
Good afternoon. Good afternoon. I tried to do this. Good afternoon. I'm not sure why there's a second row normal sitting here, because the second row, every person who sits in the second row gets a bottle of wine. But no one's moving. So let's go to market actions. Thank you for coming. I think I'm very thankful to have a chance to be part of this. This topic on ESOP actually has occupied my mind for a long time. I will share an incident later on a panel about when I was at Publicis and WPP. I saw a company that we acquired in 2012. I saw what the founders did an hour before the deal was closed. They made some changes to the ESOP table, right? And some of them was positive, some of them were not so positive. Then you ask yourself, what is the purpose of ESOP? Okay, we should come back to today's conversation. And before I do that, I wanted just to call out all of you who make time on a Thursday afternoon to come here. I work for two big MNC conglomerates who are also owned by my friends of Israeli origin. I had Jewish bosses for many years, and on Fridays, I'm not supposed to bring my laptop to the office. So when I was called and I was worried because they asked me to bring alcohol to a Jewish law firm on near the weekend, so I thought that that's no good for me, right? So luckily the event was on a Thursday, so I think I'm spared some comments. I want to also share with you that today's event, ESOP, is always about looking at people, looking at staff, people in the companies at the bottom rung of the society or the company. And on that same thinking, those of you who are here early could have seen a charity poster outside. It's a local Singapore charity that actually is a government charity, but it helps people in the lowest strata of society, right? Those people in society who can't afford even funeral services. Okay, they come from the poorest strata of society. So this charity actually provides all the funeral services for members of Singapore public here who can't afford it. So those of you who are out there later, when you have, after the event, you feel that there's a lot of value today when you're drinking a wine, please feel free to make a donation electronically, okay, on the electronic board out there. Well, I'll remind you, my colleagues will remind you, make a donation, and then you can drink your wine in peace and be at peace with yourself, okay? And so both the charities and the work today, there's some linkage. And without further ado, I don't want to talk too much about this. I'm an extended VC. I run a couple of funds that's anchored by a company in Singapore you might know. It's called Temasek, right? They are, okay, I think they know what they're doing. They put some money with us. I invest in digital economy startups, tech startups, and I come from, I'm an extended VC. I came from the digital data tech world, so a lot of the investments I do are in that space itself. If you want to know more about it, my colleagues, Yanisa, we share around, and I've also have a lot of ex-colleagues of mine, interns of mine who are now successful entrepreneurs, founders. You can find them among the crowd. They're in the space ready to give ESOP to their future staff and perhaps to their old boss like me, Yeah, can you give me some ESOP, guys? Other than that, I'll now pass you over to my more learned partner, friend here. Lawyers, you call the other guy the learned friend, right? In the court. Right. I was in court, I heard about my learned friend will now take over. And thank you. Please enjoy yourselves.
Hey everyone, thanks for coming. So I think to kick off the session, we have Stephen Diosi, a partner from our London office and the head of incentive arrangements, to begin the session. So Ying, can you put up the slides?
Hi everybody, it's Stephen Diosi here. Hope you can hear me okay. I can't see myself on the screen, but hopefully you can either see me or hear me, or both. Really pleased to be able to have the opportunity to do this. Unfortunately, those that are online have to supply their own wine, and socialize just on a one-to-one basis. But I'm glad that everybody in the room has the opportunity to be together and to have this discussion and hopefully some really insightful, informal discussions after the actual sessions. So as Siwe said, my name is Stephen Diosi. I'm a partner at Mishcon de Reya. I head up the incentives practice at Mishcon, and have been advising companies and other types of organizations on this topic for over 20 years. Advising startup businesses, high growth businesses, those backed by private equity or family owned businesses, and listed companies as well. I'll introduce the panel shortly, but in terms of who is going to speak on this session with me. But I just wanted to, I guess, introduce this topic that we're talking about. And I think the sessions, all three sessions that we're going to cover is a sort of a really dynamic area, and I think showcasing what we need to be thinking about in the design and structuring from the tax perspective, but also a real practical implication of what companies need to think about and what their executives, employees are really kind of motivated by. And I think it's a real journey for the company. The dynamics of share plans do change quite significantly when we're looking at those smaller startup businesses or those who are backed by venture capital businesses to those that are then on that longer journey and become large private or listed companies. And I think actually from an advisor's perspective, I just wanted to sort of say from my own experience that actually probably looking at a decade ago, the majority of our clients were probably that much larger listed company organizations who were much more sophisticated and are more sophisticated in their share plan arrangements. But we've seen a real shift, I think, over the last few years in terms of the private companies, the strategies that are available. And I think a lot of it has been swayed by, to some extent, private equity have been more open to opening up their share cap table and exploring opportunities with employees on a wider basis. We've seen a lot of the key executives moving from larger businesses into more entrepreneurial businesses, and part of their expectations and packages are around ESOPs and other type of share incentive arrangements. And there's just been a general increased awareness and I think market shift on a bit more of a global stage, where we've often seen the UK and the US being very, I suppose, strategic and sophisticated over a period of time. We're seeing APAC region, we're seeing other parts of Europe, we're seeing the Middle East, where there is a lot more appetite and desire for ESOPs. So that's really where I think the idea and I think the energy for this seminar to have been created, and hope you will find it very useful. So I guess in the first session, and if we can perhaps just, if you've got the slides up, just to move the slides on, so I can introduce to you the two people who are speaking with me, two very experienced advisors in the share plans world. Firstly, there's Chris Lee, who is a director at WTW, providing executive compensation and strategic services and advice to boards and companies, and to John Cartmell, who is a director at CSC Global, which provides trust services and support to share plans and their companies. So perhaps I can just turn to each of them to give a very quick introduction yourselves to everybody, and perhaps I can start with Chris.
Thank you, Stephen. Good evening, all. Very nice to meet you guys, to meet you. My name is Chris, and I lead the Executive Compensation and Board Advisory Services for Asia Pacific. And my team specializes in designing, implementations, as well as reviewing of executive compensation plan. That covers both your fixed compensation, short-term incentives, long-term incentives, pre-IPO, at IPO, and post-IPO as well. Our clientele is quite varied. In Singapore, we are the trusted advisors for Temasek, as well as its portfolio companies. So for the likes of Singtel, CapitaLand, Mapletree, and so on and so forth, and including all the way to the startups and the likes of ventures capitals in the region. Yeah. So in my capacity, in the last couple of years, I've had the opportunity to design various types of incentive plans across the different stages of growth, and it's quite interesting. Even, for instance, design incentive plans for crypto companies or the Web3 companies. These are quite up and coming. There are a lot of discussions of whether or not it is possible for us to use Bitcoin or the likes of crypto instruments as part of this incentive plan. So a lot of things have changed and emerged, and we'll be happy to share some of the key underpinning principles of those.
Thanks so much, Chris.
Over to John.
Thanks both. Thanks, Chris. Thanks, Stephen, and good afternoon, everybody. My name is John Cartmell. I'm a director in the Executive Compensation Services business here at CSC. We are a global business, about 8,500 people in 140 jurisdictions, providing predominantly corporate services, trustee services, and fund administration. The exec comp team is headquartered out of our Jersey office, so Jersey and the Channel Islands, which is where I'm based today. Unfortunately, I couldn't be with you in Singapore, much to my regret. But we do actually have 3 offices in Singapore, and I am out there quite regularly and spending a bit more time focusing on the APAC region. Within our exec comp team, we broadly cover and look after incentive arrangements across shares, fund units, cash, and savings arrangements, as well as some carry for private equity. But today we'll be mainly talking around trust work and employee benefit trusts and their use within ESOPs. So predominantly equity-based and share-based incentive arrangements, and that'll be across a mixture of private companies and listed companies.
Right, thanks so much, John. Thank you. And I think I'm right in saying in the room you should have been presented with a QR code. So if you do have any questions, I understand that is the way in which you can raise the questions, and then I think Seaway is very kindly going to read them out, and then we can take those forward. Without further ado, I think what we wanted to first cover is really the why and the how, and perhaps if I can turn to Chris first, and moving on to one of the slides, I just wanted to sort of ask Chris really to sort of talk to us a little bit, because we speak to many companies about the structure of their incentive arrangements, how to model them to be tax efficient, and how to make sure they're compliant with local regulation. But before delving into the detail of all of that, we always want to make sure they've got a solid foundation, an understanding of why they're implementing an incentive arrangement and the structure they've chosen. So how do you guide clients on this? And are there some principles that you think clients really need to understand?
Thank you, Stephen. I think in Willis Towers Watson, we do believe in 4 key principles. I think if you move on to the next slide, please. Incentive arrangement is not really a rocket science. These 4 key principles applies to companies across all types of growth. I.e., do you have a clear purpose of what does the incentive drives align with what? engaged toward what, and accountable to what? What kind of alignment are you trying to achieve from both short-term goals as well as long-term goals? What kind of accountability are you trying to establish between pay and performance in your company? Yeah. Last but not least, I think one of the most important key tenets is engagement, because I think often they're not every incentive so-called research has always been assumed that people are rational. It's not necessarily so, right? I mean, everyone has different experiences with ESOP. Everyone has different experiences with long-term incentive, RSU and PSU. Each of us have our own risk and reward appetite. Each of us has own perceptions of what is the perceived value of this incentive. And this is where the engagement tenet comes in. We delve into the psychology of pay and how we can tailor incentives to be more effective for what they want out of it. I mean, strictly speaking, if we were to give all of us, let's say, $1 million of ESOP, each of us will prescribe a different value to ESOP accordingly, based on our previous experience and based on what our expectations of the company going forward is. So these are the 4 key tenets, and I think it applies across all the different stage of growth. If I just move on to the next slide, please. Yeah. And this is just a quick overview of the what it means by having a strong purpose of the incentive plan. Like what I've shared earlier, when it comes to incentive plans, sky is the limit. There's all kinds of designs, not just restricted to the normal ESOP. You can have a value, carry interest kind of plan, carry interest inspired type of plans, long-term incentive plans, value creation plans, and so on and so forth. But the key tenets of it is that, do you have a clear objective or purpose of what does your incentive framework is supposed to drive? Yeah? So in this graphical showcase what is the actual purpose. If you have a strong purpose of, let's say, entrepreneurships when you're a startup phase, that's why you utilize your ESOP and long-term incentive quite extensively. And if you're in a growth phase, incentive is meant to drive an outperformance across the different years. And once you reach a certain level of maturity, external investors are expecting management to be more of a custodians or stewards to the capital that they manage from the investor standpoint. And lastly, we do see businesses on the mature/transformation incentive. So incentives are meant to drive those transformation purposes. And this is why it's very, very important for us to take a look at incentive, because we spend so much time looking at business strategy and adapting our processes and products every single day. But most companies fail to realize that in executing those plans, we need everybody behind us. We need the strong motivations why they should work so hard to realize the short-term goals as well as the long-term visions of the company. Yeah. And this is where I find it fascinating. It's a mix of science as well as arts, and a lot of human elements in it, because everyone will perceive it differently. Every companies have different culture, different behaviors you wanted to drive, and this is where the interesting slash fluid space is. I hope that answers that, Stephen.
It does. Thanks, Chris. And actually, it's just really interesting to looking along that graph. I suppose I'm wondering, in terms of the people that you're talking to along that growth journey, the stakeholders, do they change throughout that process? And who are you having those conversations with?
Yes, definitely. So at the very beginning, usually there's a lot of expectations from the early funders of the company, be it a VC, be it a sponsor back or corporate started ventures. At the growth and mature phase, you will see a lot more institutional investors starts to coming in, and they'll start to weigh in what incentive would look like or supposed to look like in certain jurisdictions. So, for instance, in Europe and in US, is this thing called say on pay, in which that investors do have a say and a vote on what is the executive remuneration policies, as well as the outcome every single year. Yeah. In Asia, unfortunately, we do not have that. Why would I say fortunately? Is because it does restrict the design to the large extent. LTI should look in a certain ways in those jurisdictions. But in Asia, we are unencumbered by those restrictions. Yeah. Anything is possible. If you're clear of what would your company look like 3 to 5 years from now, you're free to do what you want to do in a long-term incentive structures, short-term incentive structures, based on the right governance structure. Yeah. This is the interesting dynamics that that's quite different between Singapore and the global stage. Yeah.
Yeah, and I'd really echo that, Chris. I think, you know, from my experience in the UK and looking at other jurisdictions sort of closer to home to where we are, and probably going back to one of the comments I made at the top in terms of actually why private company type share plans has become more popular is because we've seen, particularly since the financial crash over a decade ago now, a lot more regulation come in terms of constraining the way in which senior execs can be rewarded and incentive structures can be designed. So that actually we are, you look at the listed companies and they are very similar to each other. Whereas we look at our startup phase, what do the founders want to achieve? There's a lot more focus on the people involved and the business strategy at a much deeper level, at an earlier stage. So it's about getting people involved and people along that journey. So I totally sort of echo that from what we see over here as well. Thanks, Chris. I think just sort of moving on, what I wanted to touch on now, actually, in kind of that order of events, I suppose, is what once you've thought about the why and the strategies behind it, is the how. So perhaps we can just move on a couple of slides. And the how is really where I get involved and my team gets involved in how do you structure these incentive arrangements? What does that look like? I don't know if the slides can just be moved forward a couple. Yeah, perfect. Thank you. And really, actually, once we've gone through that strategic design stage, we're looking at a number of different elements that feed into the structure. And I suppose starting at the top, really what we are, the first question we often get asked by clients is, how do we do it? And some of those questions will be answered in that design stage that Chris will be doing at WTW. But often we are then looking to finesse or work out how to do that in the overall context of a number of different factors, which we've got up here on the screen. But if I just take I guess the three overarching principles, doing it through delivery of actual shares, real shares on day one, or options, or phantoms. And just to sort of explain what each of those are, I guess from the legal point of view, is that the share element is there is real shares on day one, the individuals are on the share cap table, and they've got a share certificate in their hand, and they can be treated in the same way as other shareholders. Is that an appropriate structure versus an option where you've got, as the individual, a right to acquire some shares at a future time based on certain events and other things happening, for which you might need to pay a price, so the exercise price, or you might be given those shares for free. But certainly until that point in time, you're not a shareholder, and you only have the right to receive shares and the economic value at some point in the future, versus phantoms, which is where actually you're never a shareholder, but only entitled to receive the economic value of the growth to which the incentive has been modeled against. And really those three things, I think, demonstrate the ownership scale. Looking at, the strongest element of ownership is clearly having shares, through to options, through to the other end of the scale being phantoms. And each will deliver, and there'll be a need as to why one or the other might be appropriate. Quite often, I think, when you're looking at the early stage founders, those that are there on day one, it's quite common to see actually real shares being issued to those individuals, but it will generally be a smaller group of people. There'll be things that they'll need to be thinking about is, well, actually, what happens if somebody leaves? It's more administratively burdensome to actually have to take away shares rather than an option where if somebody does leave or the performance conditions are not met, you can simply cancel the option. It's just the contract. So it's an easier way to administer the arrangement. but you've always got to look at what is it that we're trying to deliver in terms of alignment, in terms of economic value, in terms of the feel of it from both the company and the employee perspective. And clearly where you've got other shareholders involved at the time, it can be quite a sensitive issue to open up the share cap table to others. So really, I kind of think there's a number of factors that companies need to think about as to whether they want to issue shares, deliver options, or deliver phantoms, and that all needs to be explored at this kind of stage. The tax element, and we'll come on to tax in the next session, specifically around the Singapore and US elements to it, but tax actually can be a driving factor to some of this. When I look at it from a UK perspective, actually, and in the US and some other jurisdictions, there are some real tax advantages in structuring incentive plans in a particular way, which are supported by the local regulatory and tax authorities. So, for example, in the UK, for high growth tech companies, we have a plan called an enterprise management incentive, and that will be almost exclusively the go-to plan for companies in that space, and that will be a share option plan, and that delivers some really advantageous tax treatments, which you wouldn't get through actual shares. So that would generally be a driving factor, even for the founders or for those early stage key employees. We'd often see those sort of EMI options being granted. Things like vesting and exercise, we've got to look at from the structuring point of view. Vesting and exercise, we're really sort of talking about when is it that somebody earns the shares or the right to acquire those shares or receive the benefits of those shares. And vesting might be different to exercise. So often we need to ask the client and explore, should this be an exit only type plan, i.e. we're only delivering benefits when there is an event, if the company is sold, or perhaps there's a majority investment that comes in, or ultimately there's maybe an IPO on the stock exchange. And along that journey, we might build out a vesting schedule so employees can accrue over a 3 or 5 year period a percentage of the option, and generally they wouldn't then lose that. And then when the event comes, they can exercise or they get the economic benefit of that percentage which has vested. So elements like that need to be thought about, and that will then tie into the things like performance conditions. So is it just time-based vesting? Is it time-based vesting so that as long as you were there, you continue to accrue the benefits? Or are we going to link this to the financial performance of the company in some way, or personal performance, in fact? And maybe there's a combination. Again, thinking about, is this an exit-only plan, or do we want to deliver benefits along the journey, will influence those discussions. It may be that all we're looking to achieve is an exit at a certain value, and if we achieve that point, you can then participate as an employee and accrue the benefits. Or it might be that we're looking at EBITDA growth, for example, on an annual basis, and that unlocks the ability to take value off the table at a specific point in time. And then our good leaver, bad leaver. So what happens if we've got our key executives and other employees who leave before the ability to vest or exercise the award? How do we treat that? Again, as I mentioned, the structure of the plan is quite important here, because it will also dictate the ease at which you can take things away or reduce things. And we'll often have a concept of good leaver, bad leaver. So if somebody leaves for example, unfortunately they are incapacitated or have a disability that they can no longer work anymore, that's usually a good leaver, and you would normally see that the benefits which they've accrued, i.e. that's vested, they get to keep, they don't lose it, but they don't have the opportunity to accrue anything more. And so effectively their award is frozen at that point in time. Whereas if somebody resigned or they left because of some misconduct, their entire award would be taken away, whether it's vested or not. And we need to be very careful, and the conversations that we have early on with a company will be around, well, what do those good leaver, bad leaver reasons look like? Often the company will want an element of discretion and actually want it to be more favourable to them on the face of the documents, but allow them discretion to treat people in a better way than they otherwise might want to. So again, really important conversations to be had at that design and structuring stage. And actually, the last one I just want to mention before moving on to John is around overseas considerations. So often when we're looking at a plan which is being operated in multi-jurisdictions, we might have decided on a share option program or real shares. But actually, if we want to replicate that in a different jurisdiction, we might need to change that. So it's really important that we are cognizant and alive to the issues around things like securities laws, tax laws, employment laws in other jurisdictions. Because whilst ultimately a company will want to treat everybody in a consistent basis and drive the same factors around retention and motivation and alignment together in the same way, there might need to be some nuances that we build in. So those overseas considerations, again, we would often run a feasibility study before we pin everything down and ensure that the documents give us the ability to flex things. So with that, I've mentioned employee benefit trust, but actually I want to move on to John at this point, because John, perhaps you can talk to us a little bit about why EBTs, as we call them, are important, and what is it that they do and the benefits that they give around structuring a share plan and the support that they give around it.
Absolutely. Thank you, Stephen. And if we just go on to the next slide, I think I've got some summary notes on this. That's great. Thank you so much. So first of all, just to cover some high levels around what a trust is, and specifically in this context, what an employee benefit trust is, and as we call it, an EBT. A trust is a fiduciary arrangement whereby assets are settled into that trust, and the trustee then holds those assets for the benefit of the beneficial class or the beneficiaries, which in an EBT would usually be the employees of the company. The trustee holds that value, usually linked to some level of incentive arrangement or share plan, and really the trustee is holding that for the life cycle of that share plan, whether that is for a listed company or more increasingly, as we were saying, private companies or private equity portfolio companies. There's different parties to the arrangement, which we'll come on to in the next slide, but just to say that the funding is usually provided by the company in order for the trustee to acquire the shares. That funding can be made by a gift or by a loan. There are different pros and cons to that either mechanism, but that funding is provided, and then the shares acquired by the trustee to be held throughout the life cycle of the plan. As I say, or the last point there mentions, the use of EBTs within incentive and share plan arrangements has been commonplace for UK companies for a number of years, and certainly Jersey as a jurisdiction of choice for that work has grown up doing this work. We are now seeing these being used more widely globally, and we can talk about this a bit later in the session, but you know, we are now seeing in the market a real desire for this vehicle to be able to hold these shares externally by a third party and provide a level of governance and structure around the incentive value as part of the plan arrangement. So we'll just go on to the next slide, please, and I can just cover the parties very high level involved. So the set law company is the company that will be putting the assets into the trust. So initially there'll be some initial settled funds, as we would call them, which establishes the trust. And then ongoing, there would be funding either by transfer of shares, or more usually a transfer of money in order to acquire shares, either through subscription or market purchase in the case of a public company. But the settlor is that first party. The second party to it is the trustee, who historically, maybe in trust arrangements, might have been an individual. Now is completely commonplace to be a corporate vehicle, a corporate trustee, which is what we do here at CSC. And our role and responsibility in that arrangement is to follow the terms of the trust deed, but ultimately look after the interests of the beneficiaries. We are not we're not necessarily there to provide benefit, or definitely not there to provide benefit to the settlor company, but we are there to look after the interests of the beneficiaries. We will always act in conjunction with the settlor company. We have a mechanism, usually by letter of recommendation, by which the trustee will receive recommendations about what they would like the trustee to do with those assets in the trust. And again, there are various mechanisms and documents that we would enter into that may commit us to provide certain benefit or certain shares to certain individuals at certain points, subject to conditions, whether they may be performance conditions, as Stephen mentioned earlier. And then the beneficiaries are the last party in the concept of a trust. As I say, in an EBT, they would usually be the employees, former employees, and actually a little bit wider in the sense of relatives of those individuals as well, of the company. There are occasions where certain individuals or certain jurisdictions may be excluded from trust arrangements. So, for example, in a Jersey EBT, you would quite commonly have Jersey residents excluded. And again, there's flexibility within most trustees to apply that as and when required. But like I say, the beneficiaries are the key part of this from the trustee's perspective. As far as rationale as to why you'd set one up, if we could just go on one slide. There are a number of reasons. Ultimately, an EBT is an incredibly flexible tool and incredibly flexible vehicle for the company to be able to utilise within its incentive planning. But as a general rule, they're established to hold those shares in order to satisfy awards or to hold shares, on behalf of individuals through the life cycle of the plan. We provide that independence and third-party sort of governance around holding those assets. So those assets don't sit within the control of the company, where they have been allocated for the benefit of individuals. And certainly, again, this industry growing up a little bit more in the UK, the HMRC tax authority, as well as various governance bodies in the UK, all acknowledge the benefit of using a third-party trustee in this example. It provides real structure, and having a professional corporate trustee holding those shares has real benefit. As far as issuing shares, and again, this is probably more of a public or a listed company point. If we are hedging a liability for the company, so if shares are awarded on a 3-year period, for example, or in Stephen's example, options are awarded, there is a value attached to those, and there is a value attached at the point of vesting or exercise. So quite commonly, companies we work with would like to buy those shares in the market at the outset, and therefore we can hold those shares for the duration of the period of the vesting or the holding period, in which you would hope those shares would go up in value, and therefore the company has mitigated the expense that they would have at point that those shares or awards vest. The final point on there, which would be great to talk about in a little more detail a bit later on, but is in relation to nominee aspects as well. So when Stephen was talking, one of his first points around actually awarding shares to individuals at the outset rather than options or any sort of restricted awards, what we can do as a trustee as well is act as nominee. So that would mean that we have one line of ownership on the share register, which would be the EBT. We would obviously hold those records internally for individuals who we are holding those shares on behalf of. But again, there are benefits around that administratively from a confidential perspective. And so that is something we are increasingly seeing a request for our services around nominee, specifically again in relation to probably private equity portfolio company management incentive plans, which typically would look like this from the outset.
Perfect. Thanks, John. Thanks, John. I appreciate we're probably eating slightly into our allotted time at the moment. Can I just skip back to Chris before we move on? Because I think there is a couple of important things we just want to cover in terms of market practice. And actually, if we move forward a few slides, I wanted to ask you, Chris, in terms of the companies when they're at their earlier stage of life, whether startups or high growth, how do you see them structuring the incentives, and does there tend to be any variation on the ownership depending on the ownership structure, and sort of how does that move? I think if you skip forward to, I think, slide 18.
Yes, slide 18, please. Yeah. Thank you, Stephen. I think what I would like to share for today, basically, we do see a difference in the way incentives are structured across two different buckets. The first bucket is sponsored back of venture-led startups, in which founders are typically not the management are typically not the founders of the company. They are appointed by one of the ventures or the parent company to run these ventures. And also, typically, LTI or ESOP is not given to all the employees. It's only given to selected employees that are part of the key management personnel. Yeah? And the kind of incentive reward here, interestingly, what we observe is that they tend to adopt a higher fixed pay. The reason why is because their talent source comes usually from their parent company or the ventures. And these incumbents, to undertake these new ventures, they require some kind of risk premium to enter into this new role, because they're taking more career risk compared to their previous role. Yeah? And the interesting part is that ESOP does not extend all the way down, and the kind of outcome that they get out of the incentive is what we call moderate risk, moderate reward kind of outcome. Very different from what we see in the news. Typically, a founder-led startups who have typical propositions of high risk, high reward. A bulk of the employees' incentive comes in the terms of equity, be it actual equity, ESOP, or phantom equity. They will realize quite a significant value at exit, be it IPO, trade sales, and so on. Yeah, but in trade, because of that, the fixed salary and annual bonus tends to be on modest side compared to the counterparts of the established companies as well as venture companies. And if you move on to one slide, I think this is an interesting study that we did last time, that from LTIP, from the founder-led startups that we've seen from the likes of Facebook, Uber, Google, and so on, LTIP changes quite considerably across the stages of growth. At the beginning, you do have a sizable portions of the equity being owned by management, right? And out of which usually the company's shareholder agreement would have a certain quote of how many percentage you can issue that's given to the management. And for every single funding rounds, it gets diluted downwards accordingly with the new investors coming in, right? But as you go towards IPO, the most common vehicles tends to be stock options for Facebook and Uber, and it started to change towards RSUs on PSUs. Yeah? Why is that so? Because RSUs tends to be less dilutive. Options has that leverage factors. So for every $1 incentive, you get at least 3 to 4 different units of options. But for RSU or full value shares, you only get one full value shares of unit in that particular company. So that tends to be the natural evolutions of long-term incentive towards a full value shares and real ownerships of the company. And as a company go through post-IPO, it tends to get into this full-fledged RSP and PSP or performance share plan type of model, right? In which you can actually give actual shares and subject to a shareholders agreement, and you can have full flexibility of what kind of design in terms of vesting schedule, in terms of performance conditions, and so on and so forth. Yeah? And lastly, we do see some kind of variations in terms of the common vehicle awards, be it employee share purchase plan, be it retention award kind of plan, be some value creations type of plan that we do see quite considerably. I think in the recent years, you would see headlines. I think the most famous one is Tesla. Mr. Musk sizable award in the billions of dollars, and it has translated across. It made a ripple across the executive remuneration field across the globe, actually, right? And basically, he has created into this new breed of what we call value creation plan. That's characterized by one, very sizable, very ambitious goals of doubling or tripling the company, out of which management will share X% of the value created upon achieving those ambitious targets. So it's pretty much quite similar to what we see in the venture capital as well as a country interest type of plan, in which that management shares a portion of returns above the cost of capital hurdles that shareholders expect out of the venture. Yeah. We do see it creeping back into even the mature companies and leading companies, be it in Singapore, in the region, as well as the global stage as well.
Perfect. Thanks, Chris. And that's really interesting. Just to finish off this session, I'm just going to come back very quickly before I get told off back in the room for one final question. And John, can you just give us 30 seconds? And clearly to the developing market, I think out in APAC and Singapore and the region, how are you seeing EBT structures being received? And is it something which you're seeing the market developing quite well around?
Thanks, Stephen. Yes, short answer, very short answer is yes, absolutely. We're seeing a lot of interest at the moment. I guess the ideal or the main type of client we are seeing is a client that's headquartered in Singapore that may have its working population around the APAC region or even globally. Where we're talking to those companies, we're looking at probably initial inquiry around ESOP and administration, that plan administration, which we can assist with. But then there's a further discussion around the holding vehicle. And like I say, with an increasingly global or outside of Singapore population, a trust is a great tool for that. We have set up Singapore and Hong Kong-based trusts. However, we are doing more and more Jersey trusts that are, I think, jurisdictionally neutral for the global population. And yes, we're seeing increased demand, and we would hope to see that continue as the market develops around the employee ownership and incentive-based model.
Perfect. Thanks so much, John. I think that brings our session to an end. Obviously, if there are any questions, Seaway will, I'm sure you'll shout out and let us know. But otherwise, I think we can move on to the next session. Thanks very much, everybody.
Thanks very much, Stephen, Chris, and John for that interesting discussion. So I'm Vincent. I'm a Singapore qualified tax lawyer here at Mishcon in Singapore. And joining me for this second session is my colleague at the front here, Theodore. He's a dual Singapore and US qualified tax lawyer as well, and both of us are based in the Singapore office. And so today, for our segment, we'll be talking about the various tax issues to consider when implementing an employee incentive arrangement. And so as a quick overview, depending, as we have heard from the first segment, basically depending on the profile of the company and also the company's commercial objectives in implementing such an arrangement, such an arrangement could take various forms or a combination of these various forms. So starting off with stock options and employee stock purchase plans, essentially they're just giving employees the right to purchase shares in the company. Restricted stock and restricted stock units, they are essentially share awards granted to the employees with vesting conditions. And then when we come to phantom stock and stock appreciation rights, just broadly, these are not share settled awards, but rather settled in cash. And they are basically put in place to track the value of the shares that would otherwise have been awarded. And in terms of the tax considerations, that would depend firstly on what sort of employee incentive arrangement that we are implementing, and also secondly, the various jurisdictions where your employees are based. And generally speaking, from the employee's perspective, we are looking at 4 questions. The first question is taxability. Is the employee subject to tax on the grant of the shares or the options, for example? And secondly, the timing of taxation. If the employee is subject to tax, when are they subject to tax? For example, would it be at the time of grant or would it be at the time of vesting if there are vesting conditions imposed? Third would be valuation. So how is the grant valued or the gain that the employee derives on the grant valued for tax purposes? And lastly, liquidity. After we grant these awards to the employees, will they have sufficient liquidity at that point in time that they are being taxed to actually pay the amount of taxes due? And from the employer's perspective, the key question that we're often dealing with is the question of deductibility. Can the employer deduct their expenses incurred in providing these awards from their taxable income? So I'll be covering these considerations from a Singapore perspective, and my colleague Theodore will be speaking from a US perspective. So firstly, from a Singapore perspective, in terms of taxability, the good news for individuals resident in Singapore is that we are only subject to our Singapore-sourced income. So for employees based in Singapore, that means all their gains or profits arising from any employment that they exercise in Singapore would be subject to income tax. So this would include their salary, benefits in kind given to the employee, and also other payments that may be given to the employee. And that will also include share awards, stock option awards as well. The good thing about Singapore as well is that we don't have a capital gains tax. And so when the employee acquires or purchases shares under one of these plans and subsequently sells the shares, any gain that they derive on those shares, that will not be subject to any tax in Singapore. And in terms of timing of taxation, so income is generally taxed at the time of accrual in Singapore. And we have a special provision, Section 10(6) of our Income Tax Act, that basically provides for a deferral in terms of timing of taxation, where there is a right or benefit to acquire shares in any company obtained by reason of any office or employment. So that would be our shares purchased under an ESOP plan or shares awarded under an ESOP plan. So the IRAS has categorized these various plans into 2 categories. So we have employee share option plans, or we call them ESOPs, or employee share ownership plans, or ESOPs. And essentially, share option plans refers to plans where the employee actually has to purchase the shares. So in the context of ESOP plans, the timing of taxation would be at the time of exercise of the options, where there are no restrictions imposed on the subsequent sale of the shares that the employee purchases. However, if there are selling restrictions imposed, so if they exercise their options and acquire the shares, but they're still not able to sell the shares, they are only subject to tax when the sale restrictions are subsequently lifted. And similarly for share ownership plans, so if we are dealing with share awards, so similarly, if there are no restrictions on the sale of the shares awarded, then the employee would be subject to tax at the time of grant, if there are no vesting conditions, or at the time of vesting, if there are vesting conditions. But if there are restrictions on the sale of the shares that are granted to the employee, then that would be similarly at the time that the sale restrictions are lifted as well. And moving on in terms of valuation, that would be basically the open market value of the shares at the time of the taxing event. So, at the time of grant or exercise or the time of lifting of the sale restrictions, less any price that the employee may have paid for the shares. And what if, a question. So this is not a gain on the subsequent sale of the shares, but this is essentially the benefit that the employee gets by virtue of being awarded the option. So the benefit of being awarded the option is the ability to purchase the share at this price, and so the benefit that the employee gets would be the difference between the open market value of the share and the purchase price at the time he exercises the option. So that's It's not a capital gain because the employee is purchasing the shares at a discount. So the discount is, yeah, but when he subsequently sells the shares after he has bought it, there's no capital gains tax. Yeah. So in certain situations where the open market value is not readily available, for example, where we have shares granted in unlisted companies, then the tax authority in Singapore generally uses the net asset value of the shares as a proxy for open market value. So that's the general practice. And in certain cases where we are dealing with shares in SGX listed companies, for example, then because from the IRAS's perspective, you are essentially the taxing event is when you are able to sell the shares. So what if the shares are in a pre-IPO company that's about to be listed on the SGX? Then essentially the price would be taken to be the last done price on the date of listing, or where there are treasury shares that are to be transferred to the employee, then the taxing date and the value on the taxing date will be the last done price on the date on which the shares are actually credited to the employee central depository account. So as you can see from a liquidity perspective, the IRAS's approach is really just to tax employees whenever they are actually able to sell the shares. So for most situations, there wouldn't be a liquidity issue because the employee would always be able to sell some of the shares to pay for the amount of taxes due. But what if the employee actually wants to hold on to the shares? The employee doesn't want to be forced to have to sell the shares. So the IRAS also has a special scheme called the Qualified Employee Equity-Based Remuneration Scheme, or the QEEBR scheme, that provides for a tax deferral on payment of tax up to a maximum of 5 years from the date of the taxing event. And coming on to other non-cash settled awards. So what if we are dealing with phantom stock or stock appreciation rights? So these are settled in cash. So essentially, the employees would be taxed at the time that they're entitled to the cash payment. So whether or not they withdraw the cash amount, that's irrelevant. As long as they're entitled to it, they will be subject to tax as at that date. And also something that's becoming more and more popular these days, especially for companies in the blockchain industry, is that they will be receiving tokens instead of shares in the company itself. So the tokens will be actually the valuable item being granted to the employees. So there are no specific provisions dealing with digital assets or tokens in the Income Tax Act, but from a practical perspective, the IRAS has said in administrative guidance that they are going to apply a similar approach as to shares. So basically, where tokens are issued as a form of remuneration, then they would be subject to tax in the hands of the employees, and they will also be taxed when they accrue. And the accrual date would be whenever the lock-in period ends. So for example, there may be a lock-in period where the employee is not able to sell the tokens for this period of time, or where the sale moratorium, so there's a period of time that the employee is not able to sell their tokens on the open market. So essentially, the IRAS would treat the taxing date as to when the lock-in period ends or when the sale moratorium is lifted. But and so a relevant consideration for companies awarding tokens to their employees or founders would be to consider the valuation at the time of which the lock-in period ends or when the sale moratorium is lifted. So at the time that they are granted these tokens, for example, the tokens may not be worth much. But if there's a long sale moratorium period, the subsequent value of the tokens may have appreciated substantially. And also to consider their liquidity at that point in time as well. In terms of deductibility, yes. So the employee is based in Singapore. It will be taxed at the personal income tax rates. So there are basically marginal tax rates from 0% up to 24%. Yeah. Okay. So from a deductibility perspective, we have specific provisions in our Income Tax Act as well that provides for a deduction for companies on their costs incurred in providing for these employee incentive arrangements. But one important point to note is that this only applies on the costs incurred by the company in acquiring treasury shares, so their own shares, rather than issuing new shares. And that's because whenever you issue a new share, there's no cost incurred. It's really a movement of your capital account on your balance sheet. And so so there are various situations where a deduction will be granted. So whenever for example, a Singapore employer, the company itself, acquires its own shares and grants these shares to the employees, these would be deductible. If an employer's holding company, so where we are talking about a group sort of situation, where the Singapore employer might be part of a larger group, the holding company of the group can acquire its own shares and transfer them to the employee as well. And if the holding company then recharges that value of the shares to the Singapore employing entity, that amount would also be deductible as well. And lastly, we could also have a SPV sort of structure. So similar to the employee benefit trust that John highlighted in the previous segment, you could have an SPV also acquire shares either in the Singapore employing entity or in the holding company as well. And the costs that the SPV passes on to the Singapore employer would also be deductible by the Singapore employer as well. And in terms of valuing the cost of the shares for the purpose of this deduction, the employer in Singapore can either use a first in, first out basis or weighted average basis. And just quickly, some more issues for employers to consider in the employee incentive arrangement context is firstly, if we are dealing with Singapore shares that are being issued to employees, stamp duty on the transfer is something to bear in mind as well. So stamp duty applies on the transfer of shares in a Singapore company at the rate of 0.2% of its fair market value. But however, there's no stamp duty on a new issuance of shares. So factor this whenever we are thinking about putting in place a structure for your employee incentive arrangement, as transferring shares would attract stamp duty. The next issue that's very common is to ensure accurate reporting of gains under the auto inclusion scheme or in Appendix B of Form IR8A. So in Singapore, the employer is actually obliged to either report employee income to the IRAS directly or to provide a form to the employee for them to submit their own personal tax returns. So where there is inaccurate reporting done, what we commonly see among companies is that they will have to do a voluntary disclosure with the tax authority in Singapore a few years later, by which time they would have to pay a small amount of penalty if they voluntarily own up to the tax authority. A third issue that also comes up in the context of groups of companies where we have multinational groups, for example, and we have a Singapore employing entity, is that if the Singapore employing entity is being remunerated by other group entities on a cost-plus basis from a transfer pricing perspective. So the cost of these implementing these ESOP or ESAL plans would typically be recharged back to the Singapore employing entity. And these costs, being the cost base of the Singapore employing entity, may get scooped up in calculating the cost plus service fees that other group entities will have to pay to the Singapore employing entity. And so if you are in the situation where the Singapore employing entity is not able to take advantage of the deductions, but yet they will receive this outsized service fee that actually encompasses the cost of the ESOP or ESAL plans, then they would then have face a larger tax liability in Singapore due to their outsized calculation of their revenue. And the last issue to bear in mind also is for non-Singapore citizen employees. So employers in Singapore, whenever non-Singapore citizen employees, including Singapore PR employees or employees on employment passes, when they cease employment in Singapore, the employer has to withhold all monies due to the employee at that point in time, and also to submit a tax clearance form to the tax authority. And at that same point as well, to the extent there are any unvested share awards or unvested share awards or unexercised share options, then those share awards will be deemed exercised and share awards will be deemed vested. And any gains at that point in time will be taxed, and the IRAS would then claim tax from the amount withheld by the employer. So that's something to bear in mind. So for international employees employed in Singapore, that's a discussion to be had whenever they are awarded shares under this scheme, and also from an employment contract perspective, to build in extra provisions to ensure that any amounts in excess of the amount withheld by the employer the employer would be able to claim such amount from the employee as well. So that's basically it for the Singapore position. I'll hand the mic over to my colleague Theodore, who will talk about the US position. Thanks.
Right. Evening, everyone. Thanks, Vincent. In hindsight, we probably shouldn't have picked the day after election day to sort of talk about US issues. Could be the case that US people never have to pay tax again in the next year. Uh, Right. So, as Vincent mentioned, I'm US qualified. I advise clients based out in Asia on US tax issues. I work with my partner, Tim Burns, visiting from Hong Kong. So I think the first question that many of you might have is, why think about the US? And really, this comes up in two sorts of situations for us. First, you might have US citizen employees, green card holders. These people are subject to worldwide tax, so you've got to take into account their US status when you're granting them incentive arrangements. Second, and I think this might be a bit more of interesting, is oftentimes the US becomes relevant in a later stage of a startup's life cycle. You could reach a stage where you've raised a series round and you're relocating the business to the US. You've got key employees which are moving there. And as a result of some incentive plans you set up years earlier, these don't necessarily work from a US tax perspective. And that can have some serious consequences. And that's why, to the extent that you can sort of deal with these and not sacrifice any of your immediate priorities, sometimes we think it makes sense to give a little thought to the US issues when you're structuring your incentive agreements from the get-go. So just some very high-level points here. US citizens, green card holders, residents based on a day count test, they are subject to worldwide income tax, ordinary income tax up to 37%, long-term capital gains, so assets that you've held for longer than a year, 20%. Some exceptions for items like gold, crypto, collectibles, art, those have a 28% capital gains rate. If you're living stateside, you've got state and local taxes. There's also US gift and estate tax issues. Those are more of an individual issue. We sometimes advise founders on them. That's gonna differ from each individual circumstance, so we're not gonna touch that today. In terms of employee incentive agreements, the US world is divided into two types of plans: qualified, non-qualified plans. Qualified plans are things like 401ks. And in our experience, employee incentive plans that are not based in the US, they almost always fail these tests because these are extremely strict. So, you're always going to have a non-qualified plan on your hands. So the US is sort of like a hodgepodge of provisions that target different types of employee incentive schemes. They can get pretty technical. If you deal with the US often, you'll hear these, code sections be tossed around: Section 83, 402B trusts, 409 Cap A, 457 Cap A. The general idea that you just have to keep in mind is that these provisions are all targeted and requiring you to recognize income as it becomes vested and is no longer subject to a substantial risk of forfeiture. Though what this means actually differs across the different provisions. And if you think about it, it sort of makes sense. If you're vesting $1 million in comp this year, if you've got an option to receive 200,000 each year for the next 5 years, because of the way graduated rates work, you can actually produce a better tax result for yourself. So, 409 Cap A specifically produces a situation where you could have a 20% penalty on top of any interest and penalties that are due if you sort of like trip up this provision. So this is something that we usually think of when, we're navigating employee incentive arrangements for US persons. In terms of valuation, it's similar to Singapore. As Vincent mentioned, you pay tax based on the property, the value of the property you receive. Because the US has capital gains taxes, it's important to sort of figure out, when your holding period starts. Because, as I mentioned earlier, you've got to hold assets for a year to get long-term capital gains treatment. You also have liquidity challenges in the US because of these rules. If property is treated as vesting before you have a liquidity event, you might be in a situation where employees, have limited ability to pay the taxes. And the company has to sort of go out of its way to sort of manage that. Credit issues as well. If you've paid US taxes in year 1 and Singapore taxes in year 5, you may not necessarily be able to take advantage of foreign tax credits. That leads to double taxation. Again, something that we try to avoid for our clients. Okay, so I think so far this has been pretty technical. Maybe I think some of you might be familiar with what happened to Stripe. So they actually raised a couple of funding rounds because of some issues with their incentive plan, involving the RSUs. So maybe just to shed a bit of light on this, this is context of really late stage startup, right? They had like $100 billion valuation at some point. So what happened, was they issued RSUs to employees, and these had two vesting conditions. So one was your standard KPIs, service length, that sort of thing. The second was actually the company had to have a liquidity event. So this was sort of put in place because you wanted the second condition to prevent employees from generating a big tax bill before the company went public. But the issue here is that they had to include an expiration date on the RSUs, and once they started bumping up against the end date of those RSUs, the company was forced to sort of raise capital to buy back some of these shares because otherwise, they couldn't let the RSU plan expire worthless. So what this really sort of illustrates is that it's not that the RSUs are necessarily a bad structure. You can see the benefits that they derive from it, right? Employees didn't pay any taxes, notwithstanding the fact that the company's valuation ballooned, in the pandemic years. But the trade-off is, once you start bumping up against the end of the time horizon, it just illustrates that it's important to sort of have your exit in mind when you're structuring these plans. Otherwise you might be forced to raise capital in a situation where you don't actually want to dilute your shareholders. Right. So on this slide here, we actually have a summary of the common types of deferred compensation arrangements and how they're generally treated under U.S. tax law. In a startup, as hasn't been clear over the last couple of presentations, you'll be thinking a lot about liquidity. You don't want to put employees in a spot where they've got to pay taxes but don't have the ability to sell shares and generate liquidity. This is all pretty fair. This is all pretty straightforward. One thing I want to talk a little bit about is the treatment of restricted stock that's issued for services. So ordinarily, this isn't taxed in the US until vesting, but the US actually has what we call the Section 83B election, under which you can actually accelerate, you pay tax on the receipt of restricted property, notwithstanding the fact that you haven't actually met the vesting conditions. So the interesting thing here, is you basically start the clock on your holding period for long-term capital gains treatment. If you're a US tax resident when you sell those shares, you get long-term capital gains treatment, without anything further. So, without this election, the property would only vest when, you met all those requirements. And, this sometimes actually makes sense in the case of very early stage startups, where your valuation can be quite low, right? You raise safe funding, you don't really have a lot of assets. If you make the Section 83B election, you don't have to pay much tax and you retain a lot of the upside. It's sort of betting on the company. It could be very well the case that, you fail to meet your vesting conditions, you leave the company goes broke, but that's the sort of the trade-off that you willingly accept, in exchange for better tax treatment in the future. So unfortunately, this is something that you can only do within 30 days of the restricted stock being issued. So this is sometimes we actually counsel we advise our clients to make this election. All you have to do is file a form with the IRS. You can do it anytime. It's just that you don't think about this without, when there's no US tax nexus, right? So, something you should be aware of, you never know when this is something that might pay off. In terms of crypto, I think Vincent briefly touched on that. Crypto, Bitcoin in particular is considered a commodity for US tax purposes. So, I think many of these rules will apply to Bitcoin. Not so sure how they will apply to different types of crypto, those that sort of like border into securities. That treatment for those are a little bit more ambiguous, but maybe the Trump administration gives us a bit more clarity on that. So that's something that we're looking forward to. And I think that's it for me. I'm going to turn over the time to the people that you really want to hear from. So here's Sue to lead us into the panel discussion. Thank you, guys.
Invite the panel to come up. Need to unmute it. Test. Thanks, Vincent and Theodore. So hello everyone, I'm Sue, and I'll be moderating today's panel discussion. So I'm part of the team at Mishcon de Reya, specializing in general corporate work, M&A transactions, as well as advising startups on various matters, including fundraising and incentive arrangements. So as lawyers, we generally only get involved at the start of an incentive arrangement and then at the end when a liquidity event happens. In between, it's left to the company as well as its various stakeholders, like our panel today, to implement and manage the incentive arrangements and live and breathe the document, essentially. So the panel brings a wealth of experience and are able to share practical insights both from a VC investor perspective as well as a founder operator perspective. So let me introduce the panel. So first up, we have Nathaniel. So he wears many hats. He's a co-founder and chief strategy officer of Avium, a Web3 startup whose latest initiative is building a trading bot on Bera Chain. He's also an industry partner at MSW Ventures and a consultant at Mishcon. So Nat and I actually go back a long way. We are former colleagues and we have many stories to tell. He likes to say that I'm the one who fired him from his last job, but that, for the record, is not true. So next we have Jeff, MSW Ventures general partner. I think he's already introduced himself earlier. I will only add that in his spare time when he's not advising startups, he's an avid soccer fan and an Arsenal fan. Then we're also joined by Sam from Palo, a CFO advisory service. Sam has, in his capacity, worked with numerous CFOs to grow their function, and has also acted as interim CFO for various tech companies in their startup fundraising phases. Sam came back from his vacation and career, especially for this event, and I'm told that he put on 1 kg a day while he was on vacation. And finally, we are joined by Tinan from Saison Capital, where he leads their pre-seed and seed investments in Web3 startups globally, with a focus on Southeast Asia and India. So Tinan is also the creator and host of a successful podcast called Parents in Tech, where he shares stories about parenting, technology, and entrepreneurship. So look it up if you want to. So I think we have prepared some questions for the panel, but this is really about answering the audience's questions. So if we can either do it by, you guys can just shout it out, or we have the QR code. I mean, I'm generally skeptical of scanning QR codes, so if you're uncomfortable with that, yeah, we'll pass it back around and you can raise your questions. But otherwise, I'll be monitoring the facility, and we've received questions from earlier, which we'll try to address during the panel. Otherwise, just grab one of the panelists at the post-session reception, and just tap their brains. So just to kick off, I think, Jeff, I'll begin with you. I think earlier in your introduction, you were mentioning about this, one of the worst incentive arrangements that you have come across in your career. So I guess that's a good place to start for you to share a story about that.
Thank you for that. I think this the earlier sessions by the web panel and also two gentlemen, it actually LTIP. I actually knew stock ESOP as LTIP for many years when I was in the corporate world, right? And LTIP was always given to very special, limited group of people. And you seldom give it to the average rank and file of the employees. Usually, because there's a lot of concerns about tax structures, also the timing of you realizing the gains. Many times the comments was always about, this is not a one-way traffic, it's a two-way traffic. I think earlier the first panel, I think, talked about engagement with the staff, right? Originally, you wanted the employees to stay with you long enough to share with you at the right moments of success of the company, okay? But that comes from the principle that your life journey and the company's journey are aligned. But usually, it's not the case. And for big companies where you move people around in different jurisdictions, then surprisingly, you also have HR getting involved and moving people back to the jurisdiction with the lowest amount of tax, right? And I think the tax lawyers are smiling. And usually these tax lawyers are domiciled in the places with the lowest tax structures. That explains why they are here. So I have a lot of my colleagues in the global world who moved to Singapore just so they can realize that the ESOP plans, right? So there's the lowest tax. But it is supposed to be a happy event, but sometimes it ends up being a bit sad. So the event I mentioned about was, there was a company that we purchased when I was back in one of the listed companies. This one, I can't name the company I was working for because you will identify which company I was referring to. At the end of the 18-month due D, right, the valuation was scaled back by about 17%. Originally, when we met the company, this was the valuation, but after due D of 18 months, value scaled at 17%. So just before the end, just before the transaction was going to close, the founders and some of the early investors who have got substantial control on the board shares actually restructured the SPV that was meant for the employee shares. Okay. And when they restructured that SPV, the owners of tax shifted from the company to the employees. Right. Within the M&A team that was doing it, and the party was quite great. We hired about 11 lawyers, a lot of lawyers involved, right? I think there was some leakage of news, right? Leakage. And the duty had covered about 9 markets across the world. So there's some leakage, and the news went back. And it went back into the company. And then the honesty lines, the honesty help hotlines filled up with quite a bit of information. And because we were a big listed company, then to put pressure on the founders, on the founders, they leaked it out to the marketplace. And the public market reacted to the news and asked a listed company, why are you buying a company where the founders have such so-called dubious practices, right? Then it delayed the acquisition by about 9 months or sorts. So was there check and balance? Was there good faith? Or as to the defense of the founders at the time, it was just that they had worked a budget for the acquisition. I think they also gave themselves a big, they also passed a resolution on the board where the company is sold with a certain amount of money, they get in Asia, we call it, get an ang pao, right? From the board, they get a $50 million payout each, right? So it was quite surprising for the acquiring company and for myself, as a CEO of that company. Then I was a bit disturbed because I could be inheriting a team where I have to integrate a company that we buy into the company who are unhappy with the boss and unhappy with the acquirer who encourages such bad behavior by the bosses. So it was a very terrible situation for us. We were looking forward to having that team inside us, but I wasn't sure that morale was that good because of all the things happened. So it is a surprising note because we thought it's a happy event for everyone. Everyone was going to get money. But the way it was done, and due to reasons other than human, I think it made the whole exercise a bit sad. I'm sorry I can't provide more details other than that.
So just leading on to that, from that, and this question for Nat. I mean, given what Jeff has shared, I mean, is there anything that the employees or the company could have done to protect the employees legally such that that situation wouldn't have arisen?
So before I answer the question, I just want to say that I think in the previous sessions we gave quite a bit of information. I think everybody's digesting all the information you received. Feel free anytime to just ask questions. We have some questions we're seeing it's coming online and we've prepared. But at the same time, if you want a very specific question, if you want like free advice from lawyers because they're here, for example, these are all opportunities to kind of like raise the questions and they're obligated to say, and talk to you for free, yeah. So I mean, just take the time to digest, and then as it goes along, feel free to chip in and ask anytime. You can raise your hand, you can submit it through online, and we will make sure that we address that question. Okay, so coming back to dealing with how do you prevent? Sorry. Oh yes.
Yeah, I submitted online, but
yeah,
I can do it like this. So yeah, Floris, founder of Willis, we're an equity management platform in the Netherlands. You probably were wondering what is a Dutch guy doing here from the Netherlands. We're currently expanding to the APAC region, and we have a pretty comprehensive ESOP management feature on our platform, but it's not taking off that much and yet. But we get the feedback from partners here that it has to do somewhat with the hierarchy culture from the research. So I'm curious what your take is on that, and yeah, generally how you see how it is gaining popularity.
Okay, I take a step on that. LT plans, ESOP plans in MNCs in North America, it was dished out and given to staff of critical importance, right? People who are front-facing the company, who are front-facing, who are revenue generating, who are holding on key relationships. In Europe, it was given out equally, fairly to everyone because of the equality stuff. In Asia, most
Sorry,
times
Jeff,
is
we
given
can't
out to the
actually
most
hear the
senior people.
question. The question that was asked earlier, we can't actually hear it online. Could you mind to repeat the question before you answer, Jeff? Thank you.
Sure.
Yeah, sure. So it was a question from Floris from WeVester. So they're currently expanding their equity management platform into the APAC region, but currently it's not gaining much traction within this region from their customers. So the feedback that they received is that it is due to the hierarchical culture in Asia. And so, so the question to the panel is, what's their take on this, and do they see ESOPs generally gaining popularity in this region?
Amazing. You have a tool that records every conversation, no matter you charge on time. Amazing, guys. Sorry. Should we charge on time too? Yeah, I think, and for Asia, just to continue, for Asia, the ESOP tends to be given out to the most senior people, or who has the most senior relationship to the bosses. So that happens to be the hierarchical thing you're talking about. Often they look at, we thought that ESOP is given based on your contribution and really went along the journey. But most times ESOP here, they tend to look at it because of the time of entry. That means you are the first 3 employees, we give it to you. All right. Or because we took you out from another location, another place where you had some accrued value. So to compensate for the shares you're giving up, somebody else will give you ESOP. So it becomes a transaction, all right, a monetary transaction rather than an engagement transaction. So therein lies sometimes the ESOP being used for the different things. And nowadays, mostly in the last 5 years, the ESOP has become not LTIP, it's become STIP, right? And people are looking for short term rather than long term. I hope that answers your question.
Yeah, and maybe I'll just add to that. So the reason why I guess I'm here, it's one thing that I did 3 years ago was actually launch the first ESOP survey in Asia. And just 2 days ago, we launched a refreshed report for that. So stateofesops.com if you want to download that 40-page report. But directly answering why adoption here is low, we specifically surveyed about almost 300 startups in Asia on how they are managing their ESOPs for those who have. 58% of them use Excel, and only 17% of them use dashboards. That was what I was using my phone for, not checking my email, but checking the numbers. And 8% still use hard copy documents to track. So, like with regards to sort of the product in particular, sort of building on what's said, you are not fighting against not just a small hierarchy, you're also fighting against Microsoft Excel. So,
and maybe I just add on from the other side of the equation, the user side of the equation. I think one of the key reasons around that is also, number one, I think it's also the understanding of it, the configurations. There are a couple of dominant ones actually that is being used in the market, but when we are using it, a lot of the features, a lot of the configurations are not as straightforward. And that's the reason why we end up using Excel to, kind of manage that. And of course, that obviously leads to a lot of other problems, administratively, errors. And also, I think the other factor that comes in from what I observe is that I feel that sometimes our term sheets, our agreements are actually not standardized across the various VCs. And some of the VCs, definitely not the 2 of them sitting beside me, but some of them actually, they are not as mature, and the agreement itself actually leaves out a couple of major assumptions. So it's not uncommon for me to go all the way back and ask them, actually, what's the assumption you are using? Is it pre or post money? It can go as simple as that, kind of issue over here. So that causes a lot of issues when you use, kind of develop softwares to manage that, especially for the early stage guys.
I mean, Sam, you can confirm this as well. I think an issue as well is cost, right? Because every dollar they spend on an external platform is dollar that they can spend growing.
I would say yes, cost is definitely one factor. But that said, I would say on the other hand of it, if you are able to have a strong customer success, that's going to be very helpful, because to be honest with you, I see people using the platform that's cheaper than using my service, but paying a lot more to me to kind of verify and navigate through. So I think a good platform is definitely going to be helpful, and customer success is crucial in this case.
I run a Asian company for construction, so pre-seed, kind of early. My question is around at what stage do we need to really consider this? Right now, I'm dishing out ESOP to attract people to join me at the early stage. Is this going to be a one-way door? Once I issue, that's it? Or it's going to be a two-way door where I don't stress about it right now, use Excel to track it, And subsequently, as we raise a further round, then there's still opportunity for us to kind of fix up the mess.
I'll just read the question so that the people, which is that when as a company should you start kind of worrying about ESOP and I guess getting it more mature instead of just using an Excel sheet, more or less, right? So I have an interesting background. I mean, I now run my own company. So I have some employees or ex-employees here that I didn't give ESOP to, I think. But the point being, okay, no, I think okay, there are two questions, right? One, when do you worry about its structure, and one, when you give out your ESOP. I think they're two different questions, right? I think you need to from a startup point of view and equity, right? You need to think of equity as a very precious asset that you have, and really you give it out to people who have proven some track record, and are there, like I think in Asia at least, what we see is that the highly valued people are given the ESOP. A lot of mistakes I see being made for a lot of young companies, and every founder will have made this mistake generally, is that you give the first person that comes to you because you're like, oh, I'm taking a risk with you, let me compensate you with like 20% of the company, which will kill you, basically. So I think for founders, and I'm sure the VCs will echo the same thing. I think really making sure the right reward, ESOP equity, is given to the right employees is very, very critical. I do know a company whose first employees are actually here, whom actually receive ESOP, and they have done tremendously well. The founder took a bet on them to some extent. They also took the bet on the company, and today they are the top of the companies. They are the CEOs, whatever, the C levels, but that action came after this founder or the founding team gave ESOP to the wrong people. So I think it's a matter of when you give ESOP. It's quite important to identify the right people to give. Structure. If I were a lawyer, if I put on a lawyer hat, all lawyers will tell you must invest in the paperwork. Wow, very important. Write everything out. Generally speaking. But as an operator, I can honestly tell you that I think for the first maybe 1 to 3 or 3 to 5, if you are giving the right people the right ESOP, you shouldn't over worry about having a 40-page scheme rules. You shouldn't, right? It should be a simple. I think there should be some corporate governance. You should put it down in a 1-page letter. You should kind of run through the scenarios, which a friend or anyone here maybe can go through with you. But I think at the start of the company, it should be, 1 page, proper terms, properly written, but not that kind of like 30, 40 page. I would think that maybe after your seed round or towards your A is when you want to give more than like 10 people is where you start, and where insti money comes in, like Jeff or Chinan, then they will say, okay, hey guys, you should think about this. Let's put aside some of the funds to invest in a proper infra to build your company.
I'll throw in with a little bit of numbers because we had the benefit of doing that study, right? In 2021, we did it right at the peak of the bull market. Less than 20% of founders use ESOPs because they want to increase liquidity and save costs. Aka, pay your employees less, right? If you give them ESOPs, you can pay them less cash. Given where we are today in the market, the number has doubled. It's 38%, right? So it is concerning because ESOPs and shares are anything but cheap, right? And it's a one-way door. It's very different from cash, right? Cash, you earn more revenue, you can pay more cash, that's fine. It's fungible, right? But shares is non-fungible and it's a one-way street. So for those, if you fall in the 38% of founders who are thinking of using ESOP to increase liquidity and save costs, I'm not saying don't do it, but just know that it's not really saving costs, right? It's cheap. It's not cheap. So yeah.
Ethan, I'm going to give you another example of a good company because I've been talking about bad companies today, examples today. There was a company I know, I think the founders decided to give ESOP to their key staff. And this was on the basis of engaging them that joined the journey. So they gave a set of ESOP to them, and the vesting period was standard 4 years or the next liquidity event. All right. So the journey to the message by then was to the employee number 2, right, was, hey, stay with me for the next 3 years. If we hit the targets, we got an insti round that's coming in from the insti people coming in. I can buy your share back. I pay you the amount of money, I buy your share back. So I restock the share capital. Then I will ask you, are you ready for the next journey, the next 3 years? If you are, we set some goals, we reset that again. So you allow the employee to have a double dip, but only the key ones. I've seen a company too, a company that exited, which I invested in and exited to Salesforce in US. They said the ESOP, so ESOP today is not just on-way traffic. There's actually, you can take it back. So you don't worry about losing to 70% of a company by Series B. And that's your worry, I understand, right? I could see it on your forehead. Yeah, but if there was a company that said that, hey, then you can give a choice back to the employee. Say, next liquidity event comes, it is above a certain level. Okay, I will take your ESOP back. If it's below, it's between this level, you can decide to sell it back to me, or you can hold on to it. So you can do a drag as well in ESOP if you want to, all right, and follow. So there are companies, but you must be very clear, like just now the chart, there are the 4 things there. It's really about engagement. The 4th one, then let it be engagement. Most times it's the jumble between the first 2. Okay, then I think the purpose behind it is more important. The substance, the form is ESOP, but the substance behind it is a lot more important. You can ask the lawyers later for some free advice.
When a company raises capital from VC, thank you very much. Then when a company raises capital from VC, there needs to be a negotiation with regards to that cash out for employees as well, because many VCs actually like to increase the option pool at the point of the capital raise, right?
Yes. And okay,
we're back to the bad territory, right?
No. It's good. It's a good question. I think VCs tend to want to. Many VCs, and let me qualify that. The last few years, there's a lot of cheap money in Southeast Asia, and far too much cheap money coming through. So many of the processes are too, what I call KISS, keep it simple, super simple. So as a result, many of the term sheets are very
structured.
They download from free Excel templates on the internet, right? So too many things are downloaded, and some of the structures are too simple. I have seen the same grammatical error in about 15 term sheets. So they probably downloaded from the same source, right?
That's why you need lawyers.
and why?
Sales pitch.
and why? Yeah, we need lawyers, correct. And the report as well.
Yep.
I think Chin's report. So they try to do this 15% thing. So if people ask me, hey, Jeff, do I take the angel money first? Do I need to give ESOP or not? So some of them so a lot of VCs, when they come in, they will just say, hey, you need to do the 15%, dilute the thing so that I don't get diluted. Okay, the employees, the investors have a right to ask for that. But a lot of the founders will say, yeah, but you dilute me. Then they start being creative. They say, okay, we'll do 15%, 10% I will hold. It comes back to my pocket. Right. But so I think that understanding the VC needs to be clear that this is an incentive tool with people to get to the right people. But if you pick the right person, give the ESOP a person, your growth is there. Your next round you get instant money, you can buy it back, you can restock your capital. That is a possibility. You restock your whole cap table again. That's one. Second, I think while you're doing ESOP and LTIP, I will actually encourage founders, or even the platform, my Dutch friend, I like Dennis Bergkamp, Arsenal fan. Yeah, the platform of that you should also, your ESOP should be done in consideration with your angel investors. Get your angel investors out of this. If you think they help you with the money, and good, put a provision there where your next liquidity event comes, allow them to go, or let them go if your hurdle rate is good enough. Then your pool is again better. Okay, it could be your dad, your mom, and by then it could be your ex-girlfriend. Just give it back to the ex-girlfriend the money. Okay, so I think it's important because don't have silent people that become strangers to you on a cap table. And then I think Sam will tell you a bit more. Some of the companies older, the angel investors become silent and become far away friends, no more friends. Okay, so I thought that is another way to get your table back, so you don't worry about your 15%. So I didn't get your name earlier. Alex, that's right, Alex. Yeah, we shook hands earlier. Apologies, I belong to the older group.
A lot of confusion can occur when companies communicate percentages instead of amounts, especially because in the early stage of a startup, a lot of dilution is happening, and then at the moment when it converts, they end up with less percentage than they thought they had initially. So that's also a very important thing that we come across with a lot of founders many times.
That's why you have someone like Sam, does financial planning for all these companies.
Well, one of the key things, just to address back to the first question earlier as well. Okay, before that, sometimes you just need to understand the intention. The intention is non-dilution, not so much about you issuing everything. But, back to where you come from, and I think what I observe is when you're earlier stage, chances are you might not need a structured plan because it's just a promise they have with you. The whole intention of ESOP is to grab them in to be with you. And when you grab them in, it's actually a promise from you. Even at the end of the day, you don't give them anything, it's just a promise broken. And, it's only when you start developing a little bit more, people see it a little bit more tangible. That's where these ESOPs and all comes in. It's just that sometimes a very important thing is don't overpromise at the start. So one thing I observe is people will say, I want to give you this percentage, this, everything, but the truth of the matter is it won't happen in the end because there are other factors that comes in. So perhaps the promise is just purely, I'm going to give you something to reward you in the future. Grow with me and grow along the way. And second point I observe also is that a lot of times, the people that you get at the start might not end up to be the right guys for you to start scaling the firm. So when you hit Series A, Series B, unfortunately, they could be good employees, they could be good, trusted pool of people, but they might not have the skill set to help you to move to the next phase. And then you have a struggle there because you have someone with a very big stake in the company, but yet at the same time, you need to hire a more senior person that you probably have to give a lower, maybe ESOP or any incentive plan. And then it becomes a problem for you. So effectively itself is about how do you position, how do you persuade, and at the end of the day, how do you promise?
So we have another question from the audience. So I think this is a point you alluded to earlier that L tips are becoming S tips, right? So with Gen Z's shorter average tenures, and so how effective have you observed traditional ESOP structures in promoting stability among this demographic? And are there alternative or supplement incentives that can align better with their career expectations?
This is a lawyer charge time question. Okay. I think a number of founders that I've met in the last 3 years, in the last 3 years, not in the past, have had prior experience working in bigger corporates and have now transversed into the startup world a bit better. So their models of employee engagement and reward schemes are slightly a bit more, I would say, it's almost like a buffet list rather than one option, okay? A buffet list. So I've seen a ESOP program where the ESOP is awarded not based on the importance, but based on sales, based on clear sales benchmarks. When you're doing, they say that the 3 accounts, I'm hiring you from IBM, you're here, we're going to move from being a subcon, for SI firm, the subcon to the main con, the main tenderer. So we're going to get reliable relationships, get these 3 customers, they have signed contracts on our letterhead and not with the main con, right? So clear KPIs. If you deliver this, you get ESOP, right? And the volume amount of sales you bring in is equivalent to the ESOP you will get, and they're very clear on that. So we saw structure of incentives, ESOP incentives based on actually sales targets in lieu of sales commissions. Okay, so that's one. I've seen that coming through. Second, I've seen another one, which was a bit interesting. It was an ESOP built with an ESAO in. Okay, if you hit certain level, you hit these numbers and all, you have the right to purchase some shares of the founders. The other way around. So suddenly the employee feels that I join you because I believe in you, and you'll stay with me. Now I can be a part owner and buy some shares as well at a lower valuation and be part of you. And in due course, be a substantial shareholder or sorts, right? And so you see, this is a combination of these two. Recently, I saw another one. Where a company, where a key employee, I think he's holding a US. a green card. He didn't want to get any ESOP because it goes into this double taxation thing. He had an auntie who's in Singapore, and then he used an SPV to hold his ESOP. So the company gave me ESOP, but the ESOP issued to the SPV, the special purpose vehicle, private limited in Singapore, right? It became an entity rather than a human. Then I think the founder was a bit asking me, he said, Jeff, what are the tax implications of this? No. So I said, well, when you get a duty from a big insti investor, they will say, why are you giving to a non-living thing? Which is a legal entity rather than giving to a living thing, which is a human. So there are many ways you can do this to help the employee, but those things sometimes, too many loops, it gets too complicated. I hope I answered that question.
I was just chiming in from my own experience because I deal in consumer tech, and generally consumers are always young people, TikTok, all that kind of stuff. And it's very true. So it's two different kind of paradigms. I mean, the fact of ESOP equity, right, is that it vests across a period of time, right? There's a point where you sell and then you get your big kind of cash. What we are finding is that sometimes, because of shorter attention span or culture, whatever, right, that younger employees may not be incentivized by this kind of thing. So we actually do tie, like what Jeff said, remuneration or bonus or whatever to revenue. So whenever the company gets a liquidity event, be it through the year was a smashing year for sales or whatever that revenue structure is for the company, we then tie it to the employee directly in terms of, a combination of, what was direct contribution, how long you've been, what's your seniority. And we find that, it seems to be quite palatable amongst the younger employees because it's shorter term. From the founder perspective, you're balancing a few things. We get to retain equity. It's a burn on the company because it could be reinvested as well. But I think the new wave of startups, which I think both VCs are looking at, is that given the lack of this free money and interest rates, well, Trump just won, so who knows? Is that there's a lot more focus on actual revenue, and it aligns actual revenue with actual contribution with the people who are on the ground bringing the revenue. Yeah. And it's worked for us.
And of course, it might work both ways as well, right? So there are other clauses and things if you don't perform up to a certain standard, right?
Yeah, by and large, I think ESOPs shouldn't be evergreen. Okay, I think within a certain time, sometimes you might want to get someone in because you give up a $25,000 corporate job to join you. You give him some ESOP, but if it doesn't work out at a certain point in time, lay clearly in the paperwork. When he leaves, you take it back from him, right? And it is a requirement, and it's stated in such a way that it is a transaction that has not been fulfilled. It's just a promissory note. So those things you have to do in these days.
Yeah, I'm just going to give an example over here of one, but it's a bit overcomplicated. The whole concept of good liver, bad liver. They literally have a very good liver, a good liver, a bad liver, and a very bad liver. So literally, they plan out every single scenario over there, and eventually, decide what to do with that.
Averagely good, no?
Frankly speaking, it's just too complicated.
I have actually seen I thought I'd say something more positive again before we go to mine. I actually met a startup who got acquired, and it's got acquired, and the due diligence was done very well. And then an hour before the end of the transaction closed, right? The founder had got a bunch of lawyer friends, a good friendly lawyers who gave them cheap rates. They already had a set of documents ready around. An hour before the transaction closed, they signed all the documents and gave 20% of the company away, 1% each to the first 20 employees. An hour before the transaction closed. And then after that, they signed, and then they asked the employees to sign them, join them in the office in the meeting without telling them that they signed it, employees signed it. And then those became the new cap table. So the transaction happened, each of the first 20 employees got 1% of the share. So it happens, good things can happen that way. And that's a good use of lawyers.
Well, I'm going to be a negative person over here. On the other flip side of it, I have seen cases before that almost went to a situation where someone with an ESOP promised an ESOP, just refused to sign when the ESOP plan was not done properly. And it kind of almost halt the whole transaction. So it can happen, so be very careful about that.
I think we have a question from our participants online. I think, Chris, do you want to ask your question? No? Okay. If not, any other?
I was prodded by Jeff to ask a question. So, I have been a corporate guy. I've been in startup, and I'm a fractional CMO in some places, and now I'm doing a agency leadership role. And some of my compensation has been as advisory stock options. We heard something about Phantom today. Is it similar to what VSOP is being told? I have some virtual stock options. So is there any clarity that you can drive on what is virtual stock options?
Yeah. Yeah. So I mean, phantom shares, you don't actually get shares or options. It's a contractual economic right. So basically, the value is, I guess, the difference between what. So you get a theoretical value versus the cost of what it was issued at. So you don't actually ever get share rights. It's just contractual.
The same as virtual stock options?
Effectively, it is. I mean, actually, options, they may not result in shares either, because and oftentimes actually for a lot of the startups that we advise, even though they issue options, there's always discretion by the board to not issue shares and cash settle instead. So yeah, effectively it's the same. Yeah.
Yeah, regard to the question, I think there was that slide just now earlier with the graph, right? Companies in the third segment, the bigger companies, they tend to issue options, and they tend to pay you the options back and take back, so that you can't exercise your right, because they want to maintain a share capital. Just like we were sharing about how to put clauses in place to take the money, to buy the shares back from the early angel investors. Likewise, I think sometimes the phantom shares come in different form. I've seen a company which it's a public listed company. I'm a shareholder, and then someday I didn't understand that company. The company started to give every employee. The company had 96,000 employees across the world. They started to give every employee 5 shares. I didn't understand why they were doing that for, because as a shareholder, then I realized that they were doing so because they could get a big tax relief check back from the EU. So those are but those shares when issued to employees mean really nothing, because you don't get anything back out of it. So I would classify them as phantom shares because of certain rights to that. So, but I think that by and large, if it's going to be something about a real relationship, economic transaction value, then it should be real, it should be realizable, and it should be clearly stipulated. We should write the trigger points.
And maybe just to add on, another reason for phantom shares to consider about also is for the administrative side of things. Imagine you have a lot of people to get things signed off on different fronts. When they do exercise down the road, not that ideal.
I think we have time for one last question.
I have a question that someone texted me in the room, but it's a short one. It asks about, can ESOP shares, when it's being issued out, can ESOP shares be used as a collateral? Someone asked me the question before. He said that, I got awarded ESOP shares and my company has raised certain valuation. Can ESOP shares be used as collateral? And sometimes when a founder, when these things go out and then these questions come out, I don't know how to answer this, because it's a very weird. Yes, ESOP is a promise of journey together, but it should be used as dollar note or credit card to give away, right? To another part. You have a breakup with your other half, you owe alimony, you give your ESOP to them. I don't think that works. But it happened in my first fund, in my first one of my companies. There was a couple that invested together in their joint vehicle, and then they broke up, but they are angel investors in the startup that I invested in from my first fund. And then they came to see the CEO, then they came to see the VC, and they came to see me and other lawyers and said that we just don't want to see each other's face, we hate each other. Can either one of us buy each other out? But for the company, I had to pass a board resolution, no? Because we are transacting at a super low rate, and it's filed in the ACRA, right? We are transacting. They broke up their SPV when they were dating to invest that $20,000. They broke up and sell off each other. So then but you register a trade sale. And technically speaking, I had to mark down my books as a VC because there was a sale of a share at such a depressed price. So those are considerations you must have when you issue ESOP, aware what vehicles you give to.
Yeah, I mean, I think to your question, I don't think the bank would be able to take ESOP as security. I don't think a bank will be able to take ESOP
I
as
think
security.
officially they can, right?
can,
It's just
can
that they won't.
Yeah.
Yeah, so officially it's still an asset. But will they do it? They won't, just like any private company.
Because there's a risk that the ESOP never gets materialized. So
Liability side
yes.
rather than
Can I
Yeah, one last question. Sorry, yeah, go ahead, Stephen.
Yeah, just it's a really interesting point on that. Typically, when we are looking at that, that's also a question that we're often asked. We would, from a legal perspective, pretty much always carve out from the ability for anybody to use options or awards as collateral. But obviously, a bank would have its own constraints or considerations around it. But from a company's perspective, we wouldn't want effectively other third parties to be able to come in and have some sort of equity interest. So we would almost always carve out from the ability of an option holder to use options as collateral or to be able to transfer without consent.
Yeah, hi. I'm Siddhant. I take care of the compensation and benefits at SC Ventures, which is backed by Standard Chartered. So yeah, I can confirm that ESOPs are not really considered as collaterals by a bank for now.
Do you use Excel?
If you would have asked me 6 months back, yes, but just now we have moved on to a new platform.
Is it Vesta?
Is it Vesta?
No. So my question to you was that as we are also building ventures, and as we have started doing that, most of the incentives are now delivered in ESOPs, and this has been a practice from cash. We have moved on to ESOPs, and I think all the new age startups are doing that, and it's rolled out to more and more junior employees as well, as opposed to being constrained to seniors. The way ESOPs are accrued, even though they are not sellable or realized by the employees, they are accrued over the time of grant to vest and creates a lot of drag on the PNL, right? And as a VC, I had a question for you, because most of these ESOPs are only sold at the time of a liquidity event. So when you come in is when that value is realized by the employees. So as a VC, would you rather like want to invest in a company which has no ESOPs because there's no drag, or is it the other way around? What's your take on investing in a firm which has significant number of ESOPs granted, but you are the trigger point for employees to realize all of that?
Yeah, I'll just start by, as a VC, I'm here to make money, right? So I think very rarely do ESOPs play a very big factor in decisions. Like there are usually a lot bigger factors at play with regards to the commercials of the company than ESOPs. ESOPs is usually a negotiated point when we are at the closing, and then we figure out whether and I think it really just comes down to, is the founder still sufficiently motivated to make this company work? That's the go no go decision for us, right? And I think we think about it in ballpark numbers. We don't go down to like, oh, is it a 12% or 15%? I'm not gonna invest because it's 12. Like, we trust the founders to exercise their discretion over it. Our job is not to micromanage how the ESOP is distributed. But if you come to us and like a Series A company and you have 50% ESOP, then that's not market standard, right? So as long as it's within market standard, which is generally anywhere from 5 to the highest we've seen is 20, that's already super generous. Like, we generally don't see that as a blocker. Yeah.
And just to add on, a couple of things, right? So I did hear that, he's talking about accounts, finance. I'm going to put on my corporate finance hat rather than accountant hat. A lot of times when you do transactions, it's never about your accounts. It's all about trying to understand the implicit nature of what the business is about. So you definitely are going to carve that out. You're going to look at it in totality. You're going to present it in a way such as really the operational business moving forward. And that's essentially what investors are looking for, and not just the compliance, FRS financial statements you're talking about.
I take another look at it when I look at companies coming to me who are raising money. It's not the quantum of ESOP that's out there. I like to know whether the ESOP is given to the right people. All right, the key critical drivers. So let's say they have 10% now on ESOP, and out of these 10, 6 are not allocated, 4 are allocated. And it goes out to 3 different employees or 4 employees who I don't think are holding any senior correct position. It's just that because they were there when they first came. So that tells me that ESOP has not been used with any scaling factor. All right. ESOP is actually a talent scaling factor. And the more trigger points and the more windows for them to exercise the value, to realize the value, the more you will inspire people to hang on with you, stay on with you, and grow with you. Right? If you really find magic fellas that are really good, that you can pay ESOP and want to go to join your ESOP, then there you have now an employee that becomes a co-founder. That's when you onboard them back as a co-founder. I hope that answers your questions. I think it's about using it in the right place.
Yeah, so I think we've come to the end of our session. So thanks to the panel for their insights and the audience for the attention and your participation. Yeah. So I think to end off, Nat wants to take a Gen Z selfie with everyone.
I'm just gonna, because it's meant to be casual, right? Yeah. I'm gonna turn around. Yeah, it's the other way around. Yeah, without the selfie.
So he's clearly not Gen Z. So can we have someone Gen Z do it?
Serious? Yeah. I fall asleep. 0.5. I aspire to 0.5. We'll just try to squeeze in, okay? Okay, you guys try. Then I'll try
The normal way.
Ready? Okay, thank you guys.
Yeah, so there's food and drinks outside, and feel free to grab the panelists for further questions. Yeah.
This is an advertising message again. The charity out there, the flag is there. There are ways to donate. Right, you can see them. Cheng Hong mentioned welfare. If you like to donate, you can donate there with the thing. But I hope you do it today. If you don't use the code, you can go to SG Living website. $50. Put in your IC number, put in your passport number. You get tax relief. Okay, but $50 is for half a glass of wine. So if you have 2, you know what to do. All right. All right. Thank you very much, and thank you for the question today.